Hey traders, Raghi here. Let's kick this premium video off with, really just yet another reminder that in this environment, gang, I am still very content being short term. And that's because this market is definitely a lot stronger than the, than the data we know, the economic data, the current situation would necessarily suggest. So at some point, we just have to acknowledge really two things. One, am I fighting a trend? Well, we're going to talk about that in this video. Where are there still opportunity to take advantage of some moves? We're going to talk about trend and range in this premium video as well, but we're going to kick it off with a look at something that we touched on in the free video and something that I want to follow up on here in the premium. Now, we use our trading range tool, and the first thing I want to clear up is if we have a gap in the morning, we will typically look for gap psychology, but that begs the question, what is sufficient enough a gap to make the open influenced by the gap psychology? And to me, that gap has to be a gap that is in line with the average to the daily price movement range. In other words, unless I get a gap that's somewhere in the vicinity, for example, on the S&P, of about 60, 65 points, it's not enough to say that we have gap psychology. Now, gap psychology is something that we can determine every morning just before the bell rings. And is it somewhere in the vicinity of being at least the average to the high end of the daily price movement range? That's what this is right here. And you can pull this right from AutoChartist. So today's gap in the S&P was about 20 points. That doesn't even put us really, quite frankly, on the grid. If at the lowest number I'm even willing to look at would be 60, 65. You can see the low on the range is 35, and we were even below that with the 20. So no gap psychology to start the morning, which means we're not looking for the first 3 to 5 minutes for a potential Momo breach and sort of a directional indication. So we're going to wait for the 30-minute, or we wait in this environment for the 60. So you know that I've been foregoing the clearing range breaches and going right for the initial balance. So if I don't have a gap, that's kind of our first guideline. If I don't have a sizable enough gap, now you know how to size that. I'm going to go right to the initial balance breach, which means now we're using the 60-minute setting on our clearing range tool. Or if you're on TradeStation, this is really easy, gang. You don't need a tool to do this. It's just handy and, maybe a little cool to have. But all we're doing is we're looking at the high and low range, okay? The high and low range between 9:30 and 10:30. And, one really easy thing to do is just grab the rectangle drawing tool, just connect the two highs and lows in the morning and say, okay, great, that's my high-low. If and when we breach that on whatever, now this is GDX, I didn't mean to do it on GDX. Let me do this on the RTY, for example. Okay, so what do? We mark the high and the low of the first hour, 9:30 to 10:30. Initial balance breaches are about initial balance. Initial balance is the high to low of the first hour after the bell rings on the day. So bell rings, I look for low to high and just double check that this is after 9:30. It is. And before 10:30, nope, I got a little carried away over there. Here we go. So that's the key, gang. So that's my high, by the way. There's my low. So once I take that out, once I break either through the bottom or through the top, did not get the breakout through the bottom, there's my breakout through the top right there. Once I get that, now I have an initial balance breach. We had that right in there. That gives me some directional bias. We have to wait an hour to get that. We have to wait an entire hour to get that. Then what? We wait for a correction. We wait for a move to the VWAP. We wait for something that gives us an opportunity to get long from some sort of retracement, okay? It could be to the wave. It could be to the VWAP. It could be to a standard deviation, like in this case, the +1, what have you. That's really what we're looking at, okay? But here's the great thing. Once we have directional bias, we know we want to be long or nothing on that particular market. And so you're not wondering about long, short. You're just keyed in on how much of a retracement is enough, okay? So that's something we'll be doing together in the morning. And you don't need an indicator to do it, although, certainly it is nice and it makes it kind of easy. But definitely not necessary. All right, so another thing you could think about once we get the initial balance breach, and I like to outline these in these premium videos, gang, because that way when you join me on Tuesday, Wednesday, Thursday, okay, you can let me know, hey, Rog, how are those HPMRs doing for us? If we have directional bias and you give us those HPMRs that we can run on Thinkorswim, do we now have the opportunity to buy off that HPMR once we have directional bias? Absolutely. Absolutely. So think about it this way. So I'm going to scroll up to Monday. There is where's my open? It keeps jumping around on me. I don't know what's going on. There's my open. And hang on. There we go. And so if I can pull back into some sort of correction to get long, right? Whether that be the wave. So let me show you here. Here's the wave. There's a pullback into the wave. But a little soon, a little early. This happened just after 10. Here's another pullback into the wave. But where did my initial balance breach occur? Right there. Right there. Because this is my 60-minute high right here. Initial balance breach, took that out right in there. So now what? Could I play a reversion to the VWAPs? I mean, that's really my preference. We did an entire video dedicated to that on Friday. But what if we don't get that? Well, take a look. Here is my nice HPMR sitting right there. HPMR sitting right there. So we have a lot of tools automated on our charts to give us places from which we can buy. But the key isn't, oh, we've got this automated tool from you, Raghi, where you take the auto chart as levels and project the highs and lows on the chart. That's cool. But I don't want you guys thinking this is a short and then this is a buy and then this is a short, right? I don't want you doing that. A lot of folks who see my HPMR indicator think this is really cool, but they don't know how to use it, right? Because they didn't create it. And so the reason we use hourly price movement ranges is to find support and resistance. It's not a standalone strategy, gang. It's support and resistance based on historical volatility and time. That's what makes it unique. That's where I'm eternally grateful that Auto Chartist got curious about, hey, can we look at all this data we're crunching and create an indicator, create a calculation, create a way to look at the market that no one ever has before. No one had before. No one had looked at historical volatility for the retail trader. Hedge funds do, right? Banks do. And they very much base their value at risk portfolio sizing on that. But for the retail trader to have something akin to that, something similar to what hedge funds use, this was Auto Chartist that came around and did this over 10 years ago. And just a few years after that, I started using these kind of calculations on a spreadsheet, and then now we have them plotted on the chart, which is great. But without the directional bias, you don't realize that this would be a profit target. This would be a profit target, and these are entries. And it's really important to understand that directional bias. Okay, I hope that helps. We'll do this all over again tomorrow. So sometimes the market is not going to be as kind to come back and give us a correction after an initial balance breach to the VWAP. All right. Now, why were we comfortable with the long side? I wasn't happy about the long side necessarily, but we knew that our market barometer, I'm going to call it the market barometer because calling them my internals is kind of confusing because there are some things that people believe by and large are market internals, your ticks, your trends, your put call ratios, etc., advanced decliners, all that stuff. That's really true market internals. I don't use those really much at all. I do use the VIX. I think the put call ratio in certain areas is very helpful to know. But at the end of the day, I want to know where the biggest markets in the world, the currencies, another big market, bonds, what they're telling us about flow. Because remember, money is always moving. It's currency, it's electrical, and it's always moving. And I want to figure out what that path is. My father was an electrical engineer. I think there's a lot of truth to thinking about the markets and the path of currency. We're being literal about it, right? Currency. So what is the yen and the franc saying? Well, the franc was saying buy equities. It was the weakest currency. Yen was somewhere in the middle. The Australian dollar and the New Zealand dollar were very much saying buy equities, right? The Canadian dollar was somewhere in the middle. So for the most part, buy equities was the message. Bonds were a little weak, buy equities. VIX was weak, buy equities. So when you look at this collection of what I call the market barometer, it was very clear that we wanted to, for the most part, focus on the long side of the equities markets. Where we do it from has a lot to do with the structure and the initial balance breach and VWAPs and HPMRs and all the tools that we automate on our charts. But getting that directional bias down is important. We already talked about gaps and, again, focusing on if the gap was large enough from the previous close. Today, that wasn't the case. All right, so another thing that I mentioned is it's important to understand when, for example, in the case of the S&P today, which defied the NQ, because for the most part, you had some flat action financials and a fairly bullish XLV healthcare. So you want to take a look at XLF and XLV to see those days when the S&P might be able to go off and do its own thing. Can you look at the ES able to break away from sort of what the NASDAQ and tech weighting means to the S&P? And the days that is possible is specific to days where the tech is overweighted, literally overrun by the combination of healthcare and financials generally moving in the same direction. All right. So another thing I want to jump into is the daily time frames, because this is where I think things are going to get interesting into the rest of the week. We have traveled to the upper end of the range on the ES. Now, when I say the range, what I'm talking about is really the movement we've seen since this market's been, for the most part, consolidating right in here. Here we are at the upper end of the range. The previous move is down, even though we have bounced up. At the end of the day, this is still a bounce or a correction within, I believe, to be more or less a bearish psychology. All right. You wouldn't guess it with the way people are buying equities and ignoring every piece of, hard data there is. But, what do you do when you see trillions of dollars stimulating the equities markets and the economy, right? That's probably, I guess, not unexpected, but we haven't broken through any kind of key level, 200 EMA, even the Darvis value area high on the month. So we're at the top of the range. Take a look at where we are on the ES. Take a look at where we are on the YM. Remember, sometimes when you live in the 1 minute charts, you sort of lose perspective as to where the overall daily time frames are. Here's a Dow, again, heading up towards that value area high on the month. Here's the NASDAQ. And again, once again, moving up towards those previous highs. The one market that made a really big surge today was the Russell. A lot of folks ask, Rob, what about the Russell? But take a look. All right. Now, whether or not you're using the daily time frame on the TradeStation or whether you're using Thinkorswim, you'll notice, Russell made a huge move today. Does this mean I'm now bullish the Russell? Does this make it an uptrend? No, it absolutely does not. We have one green grab candle here, one in a sea of red, a little bit of blue. You can see through here and here and here. One green grab candle does not make an uptrend, gang. That is not an uptrend, but it is breaking through some of the confines of resistance that we've had, heading up towards, as you can see here, a level that we've battled with before, and that's the -1 reading on the V-score. So pretty interesting level in terms of whether or not we continue higher. A lot of folks ask me, Rog, why is the Russell up? Well, remember, if we're going to see the government extend some sort of lending to the oil sector, that's going to help KRE. KRE is a big part of the small cap, the Russell, and I think maybe that's kind of the dominoes that fell there. The pebble dropped in the pond. That is, yes, money for the oil sector. Regional banks breathe a sigh of release. KRE is up. That sigh of relief then also sends the Russell up. This is still very much a potential short, but it's kind of fired up right now. We'll see if we can find where that exhaustion level might be, and the V-score might hold the key to that. And I think that V-score is telling us, hey, let's wait for about a negative 0.8, I should say, negative 0.8 reading, which is just above the -1. So we're still a little bit below where that V-score would tell us to short, but I think we're definitely in the area. Okay, but notice the Dow, the S&P, the Russell are heading up towards their zones. What's also interesting is bonds are pulling back towards levels that we would pay attention to, right? Bonds are coming back to the 13 and 21 EMAs, closing in on the 34. If the bond market bounces, whether that be the 30-year or the 10-year, once we get that kind of bounce, we could see weight in equities. What else is pulling back? The VIX. The VIX is pulling back. Strong VIX, weak equities. Strong bonds, meaning the uptrend on bonds, as we say, long bond, short yield, weak equities. Look at the VIX trading down into the bottom of its range. So there's a lot of things right now, technically, that are showing us, technically meaning on the charts and indicators, that we could be in for a market that's setting up to move lower just for a little bit. Who knows, right? Until the next batch of stimulus comes out. But keep that in mind as we go into the week. Now, again, I'm really emphasizing this. Please keep in mind that in this environment, we have to be very patient, probably more patient than I was even 3 and 4 weeks ago. I'm not, I'm always self-correcting. I'm always going to be very transparent with things that I feel I could do better. And right now, the best thing we can do is be nimble and really sort of be very patient about levels that we want to take action at in terms of the daily time frames. Because right now, any heat, any unrealized losses that I have on my daily platform or my daily positions are being more than made up for by my emphasis on day trading. And so this is sort of the give and take with time frames that we do. Get nimble, trade the first 2.5, 3 hours of the day, and then do it all over again without any real need to see follow through on the longer term time frames. That's how we're freeing up our mental capital and literally our capital, okay? Join me tomorrow morning at 9:20. We can put this to work in the real market together. Of course, if you can't, I do send out alerts, and make sure you have your Simpler Trading mobile app ready to go. And I will definitely send out those if we can get some nice breach retreats or whatever setups we might see tomorrow. So we'll see how that sets up. Okay, gang, I'll see you in the next update.